Hey everyone, welcome back. We've now covered just about everything you need to know about investing in total U.S. stock market ETFs, including a general comparison among 4 solid choices, as well as a discussion about the foreign withholding taxes involved. By now you might be asking yourself, if the product costs and foreign withholding taxes on dividends are reduced by holding U.S.-listed U.S. equity ETFs in an RRSP, why not just buy VTI or ITOT instead of VUN or XUU? And if there were no cost to convert your loonies to US dollars and back again, you'd be on the right track. But we haven't yet touched on some of the biggest costs facing Canadian investors purchasing US listed ETFs. These are the high currency conversion fees levied by their brokerage. For example, let's compare a 10,000 Canadian dollar investment in VTI and VUN within an RRSP. We'll start both investments on January 1st, 2014, which was the first full calendar year after VUN launched, and run through the most recent year-end. Across this period, we'd find that VTI did in fact grow at a faster rate than VUN, due to its lower product costs and the elimination of the 15% withholding tax on US dividends received in the RRSP. But there's a catch. We've assumed there were no costs to initially convert 10,000 Canadian dollars to US dollars to purchase VTI, and also no cost to convert those US dollars back to Canadian dollars when you ultimately sell your VTI shares. In reality, Canadian discount brokerages typically charge currency conversion fees of 1% to 3%. You won't see this cost listed on your account statements, but the brokerage is basically taking a hidden commission during the transaction. This clever ruse is accomplished by adjusting the retail currency conversion rate the brokerage offers to their clients. To illustrate, let's assume a brokerage can convert Canadian dollars to US dollars at a favorable corporate rate of 1.25. This means that 1.25 Canadian dollars are truly worth around 1 US dollar. Now that's what it costs them. But to earn a 2% currency conversion fee from their clients, they would offer you a higher retail exchange rate of around 1.27551. This is calculated as the 1.25 corporate rate divided by 1 minus their 2% currency conversion fee. So if you handed your brokerage 10,000 Canadian dollars, they would hand you back 7,840 US dollars, or 10,000 Canadian dollars divided by the retail exchange rate of 1.27551. Seems okay so far, right? But how much are those 7,840 US dollars really worth in Canadian dollar terms? If we multiply our 7,840 US dollars by the fair corporate exchange rate of 1.25, this gives us 9,800 Canadian dollars. Even if you're not a math whiz, you may notice that's 200 Canadian dollars or 2% less than the 10,000 Canadian dollars we started out with. See how easy it is for these currency conversion fees to go unnoticed? If that's not frustrating enough, you take another hit on the way back when you sell your VTI shares and convert your US dollars back to loonies. In our 2% currency conversion fee scenario, any benefit from holding VTI instead of VUN in an RRSP would end up being significantly reduced during the measurement period. The message is clear. The fee and tax advantages of holding US listed ETFs in an RRSP don't count for much if your broker gouges you on currency conversion fees in the process. This issue becomes even more onerous in TFSAs, where foreign withholding taxes can't be eliminated by opting for US-listed US equity ETFs like VTI over Canadian-listed US equity ETFs like VUN. Here you can get slammed with both the taxes and the hidden fees. In a perfect world with no currency conversion fees, the lower product costs of VTI versus VUN would have resulted in slightly more growth for VTI over our measurement period. However, if we assume a 2% currency conversion fee on the front-end purchase and back-end sale of VTI, we find VUN to be a much better option for these account types. Last up, there's our non-registered account comparison. Here we'll assume all units of each ETF are sold at the end of the measurement period, and the investor pays taxes at the top Ontario tax rate. If we first assume no currency conversion fees, we find VTI and VUN had similar after-tax growth over the measurement period. But once we tack on a 2% currency conversion fee to the purchase and sale of VTI, we find VUN to again be the superior choice for non-registered accounts. In future videos, I'll show you one way you can avoid your brokerage's steep currency conversion fees through a strategy called Norbert's Gambit. However, Norbert's Gambit is not without issues of its own. So for now, my advice would be to just stick with Canadian-listed ETFs and avoid US-listed ETFs altogether.